What are the legal advantages of using IUL to protect your money? In this episode, I'm going to talk about several legal advantages, and toward the end, I'm going to show you a chart that one of my favorite estate planning and asset protection attorneys, one of the top in the country, created to illustrate what I'm talking about here, because properly structured max-funded life insurance has a lot of legal benefits that a lot of people are not aware of, and most people don't even think of it as sort of a shelter for liability protection. So get ready, you're gonna gain insights into some of the incredible legal advantages that IUL has for your hard-earned money. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets and minimize taxes and empower what I call their authentic wealth. But I've helped many people, including high net worth individuals, protect their assets from frivolous lawsuits or the expenses of estate tax and probate by using property structured life insurance. So let's go through some of the legal advantages. And if you're interested, it would behoove you to sit down with a sharp attorney and also a financial advisor that understands how to use life insurance structured correctly to protect your assets, as I'm going to explain. So when we talk about the advantages of max-funded IUL, this would be a life insurance where you're actually taking the least amount of death benefit the IRS will let you get away with, and you're putting in the most premium, the most money the IRS allows, because a lot of savvy, wealthy, high net worth individuals use life insurance max-funded for the living benefits, the tax-free accumulation and the tax-free income, to where every $1 million that accumulates inside of a property structured IUL can generate a 10% payout, $100,000 a year for every $1 million, totally income tax free for years without depleting principal. And at the end of the day, when you die, anything you leave behind blossoms, increases in value, and transfers income tax free. Nothing else does that in the Internal Revenue Code. I've taught continuing education to many CPAs and tax attorneys. I've asked them to show me any other vehicle in the Internal Revenue Code that does that, and they've yet to show me anything else that allows you to accumulate your money tax-free, and you can access your money even before the age of 59 and a half, and all through your life till age 120 without income taxation on that money if you do it correctly. But at the end of the day, when you die, anything left behind blossoms. It increases in value and transfers income tax-free to your spouse, your kids, your grandkids, whatever maybe your trust says, a church or a charity. So nothing else does that in the Internal Revenue Code. So let's talk about some of the advantages here. There are 38 major advantages of max-funded indexed universal life, my favorite financial vehicle. There are several under liquidity, the ability to access your money when you need it. There are several under safety. In fact, I know of no other investment that scores as high as safety. On a scale of 1 to 10, it scores a 10. Rate of return, you're able to earn rates of return averaging between 8 to 10% net cash-on-cash rates of return when it's structured correctly, funded properly, diversified, and you rebalance with annual readjustments, okay? Now, this episode is not about those 3 major benefits, liquidity, safety, and rate of return. You can watch other episodes to understand those. The tax benefits are also incredible in the Internal Revenue Code, sections 72E, that allows your money to accumulate tax-free. 7702 addresses how you can access your money totally income tax-free. And when you ultimately die, it blossoms and transfers income tax-free under section 101A of the code. The death benefit has some incredible advantages, which include legal advantages. This episode, we're focusing on the legal advantages and going a little bit deeper there. Now, you can't read this, but I'm going to articulate them. We can use it for estate planning to avoid unnecessary estate tax when you do it correctly. And it also allows you to leave behind more to your heirs. I often ask, why would you generate X amount of income the rest of your life when you can generate double or triple X, and not or? At the end of the day, when you die, why would you leave behind X, $1 million or 10 million or 50 million or 100 million when you can leave behind double that, totally income tax free? And so it's not, can you have one or the other? You can have both with properly structured IUL. And a lot of people don't understand or realize that. So the beauty legally of Max-Funded IUL is it prevents the forced liquidation of assets upon death, okay? You can protect real estate equity in the insurance. I'll show you a diagram of how that works. You get general asset protection because life insurance is next to impossible to penetrate in courts of law for certain reasons that I'll explain. And you have protection from creditors. So we'll start with that one. Life insurance proceeds, if I were to die, every $1 million I leave behind in a tax-free, income tax-free death benefit, that's not subject to the claims of the creditors of the deceased. In my case, that would be me. So unless I pledged my life insurance death benefit as collateral with a collateral assignment, my creditors can't go to my beneficiaries, my wife, or the trustee of my trust, and say, hey, Doug had a bunch of liabilities, he owed a bunch of money. Unless I pledged my life insurance death benefit as collateral to cover that, the creditors cannot go after life insurance proceeds to have those debts paid off. Okay, that's a wonderful benefit because life insurance is designed to provide protection and money for the beneficiaries, which may have nothing to do with your liabilities. Okay. Now, so there are many legal advantages here, and so let's talk about some of the big reasons why it protects your money with estate planning. So many times you may have heard the little ditty where there's a will, there's a, not a way, there's a probate. So probate, one of the beauties of life insurance, when you die, the death benefit is not subject to probate. Okay, and so we'll talk about what probate is here for a moment, but it's cut and dried. If I pass away, the life insurance proceeds within 2 or 3 weeks are going to be paid to my beneficiaries, my spouse, my kids, my family bank, my trust, whatever you set it up to do, okay? And so it avoids the probate. Now, probate is what? It is really the legal distribution of your assets upon your death, okay, to your heirs as administered by the probate court. And so this episode is not about probate or the advantages of trust, but one of the reasons why I recommend that people consider a trust in addition to a will is because if you die and all you have is a will, or you die without a will, the state actually has a will for you. It's called dying intestate, and you may not like what the state's will does, but a will basically distributes your assets to your heirs, and that's done under the jurisdiction of a court. But there are some disadvantages of that probate process, and it takes time, it's expensive, it's a public record. A lot of people like to keep their affairs private. But if an estate is probated, anybody can go in and see what your assets were. It can't be stopped once it's started, and it's conducted in every state where real estate is owned. And we'll talk about real estate here in just a moment. But when you go through probate, all the court is doing, and the reason why it takes time and money is because, generally speaking, the court is making sure before they allocate the assets to your heirs that all federal taxes are up to date, okay? State taxes and local taxes. So those are the first three. And then you've got the court costs, the legal fees of the probate. You've got the executor's fees or administrator or successor trustees. And then you've got the actual creditors. And so one of the benefits of probate is you have to file a legal notice, and the creditors have, in most states, a time frame that they must come forward and make claims against the estate. If they don't do that, then after that time frame, I think most states it's 6 months, maybe some might be 90 days, but after that time frame, then if the creditors didn't come forward, you don't have to give them anything or pay them off. You can just say, we probated the estate. That's why many wealthy people who have a trust will still have a probate done in the event of the death of one of the family, patriarchs or matriarchs, even if it's just a tractor or an old motorcycle that's not worth very much, because you can get rid of the claims of the creditors after that time frame if they did not come forward. Otherwise, it's just open for years to a creditor to come out of the woodwork and sue the estate and force some liquidation of assets, okay? Now, the beauty of a trust is that it avoids probate, it keeps things private, it sort of preserves the love of the family because it's cut and dried instead of people arguing over who gets Aunt Effie's vase or Dad's watch or whatever. A will sometimes is still used sort of like a vacuum cleaner that picks up all of the assets that were not put into the trust. They have to go through probate, but then they go into the trust for the distribution according to the trust documents, okay? Now, to simplify this, one of the nation's top estate and asset protection attorneys is Mr. Scott Solberg, who resides in Utah. And so this is his diagram. And it shows here that with, let's say, a husband and wife situation, that many times that you can set up a trust, maybe an AB trust, where you're both trustees of this trust, and the assets are divided in half, the house, the home equity or whatever. In Utah, a lot of times I'll recommend that you divide up the assets into the husband's trust and the wife's trust. And maybe the husband's trust has the business assets if they're a business owner, and the wife's trust has the domestic assets. In this Sue Happy society that we've become, if you have an accident that was caused by a trampoline in your backyard at the home, they could maybe sue if the house was in the wife's trust. Then the most they can go after is the assets in that trust. They can't come after the business assets. If somebody's sued in the business, they can't touch your domestic assets. And so you build a firewall of protection. And what you're trying to do is you're trying to cut the amount they can wipe you out in half, okay? So trust can give you liability protection. Now, for not everybody, but people who have assets, this attorney recommends you consider a family limited partnership for non-retirement investment accounts. Maybe your IRAs or 401ks would be in a trust over here, or maybe a holding company. This holding company can be here. It can also be the holding company for all of the real estate. The attorney will help you understand this, and this is a simplified diagram. You might keep your residence in a single member LLC, okay? It may be under Wyoming because there's no state income tax in some. This says Alaska. If you really want ultimate protection, many times this attorney will recommend an Alaska trust, Nevada or Delaware trust for reasons of protection and perpetuity, okay? Then with real estate or even boats, a cabin or a rental property or a commercial building, this attorney recommends that you have a separate LLC, limited liability company, for every asset. Why? The biggest mistake most people have that own real estate is they don't have any of those rental properties in any LLC. They're owned under joint tenancy, and that's fair game if somebody gets hurt or sues you. Now, if they were to sue you for a rental property, or they slipped and fell on your commercial property, or even they got hurt behind your boat water skiing, the most they can sue you for, if that's in a separate LLC, is the asset in that LLC. So I recommend that you have all of your real estate properties in separate LLCs. Because the first thing somebody's going to do when they sue you is they're going to look at how that property is held. And if it's held in an LLC with a whole bunch of other real estate, oh, the attorneys go, hot diggity dog, we've got a lot of real estate here that we can go after. If there's only one property in there, that's not as much of an asset to go after. I go a step further. I recommend to my savvy real estate investors that they not only have separate LLCs for every piece of real estate, but they have them mortgaged to the hilt and the equity up here in this Alaska trust in a Max-Funded IUL. Why? Well, an attorney who attended one of my educational seminars, who has over 30,000 clients, one of the top in the country, he said, Mr. Andrew, you solved something I've been trying to solve for over 40 years for my high net worth clients. Who is going to sue you for your real estate equity if it's not there? Okay. If it's mortgaged to the hilt, like I do, and it's up here in Alaska Trust, that's next to impossible to penetrate. But in the Alaska Trust, if it's in a Max-Funded Indexed Universal Life, there's not a law firm around who does their homework that's going to try to go after that, because there's a firewall of protection here, and there is no asset here, and it's up in an Alaska Trust, which is another firewall of protection, and it's in an Indexed Universal Life policy. And basically, in an IUL policy, what is usually perceived as a negative is that the worst case scenario on an illustration is, what if the insurance company credited you the lowest interest rate forever on that policy? Now, that's never happened. That would be like the market going down, 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 not down and then up and up, down, down, down for years. It's never done that. I don't think it ever will do that. And so it's like you got a 0% rate of return with Index Universal Life. You may not make anything, but you don't earn anything, so it's zero. And then they use the highest charge for the life insurance. It's called the mortality cost, allowed by law in the policy, which again is way higher than the actual charge, because the insurance companies do medical exams and manage their risks very well. But they take the worst case scenario, a zero rate of return for years and the highest mortality charges. And even with the max-funded life insurance, they'll say, oh, this life insurance might last 20 years with all this cash value in it, but that cash value is off limits because this insured could likely pass away down the road. And if you take all that excess cash value, which a lot of attorneys try to go after, the cash value they think is in excess of what is needed to keep the policy in force. But if you use the worst case scenario, 0% rate of return for ever, the rest of the insured's life, and the highest mortality charge, then it could lapse before their LE, their life expectancy. So in a court of law, most attorneys will say, and judges will say, you can't touch that. And so that's why Max-Funded IUL, a lot of savvy people will keep their assets, their cash, their real estate equity up here in a family limited partnership. And if you want, you can do it in an Alaska trust, but you put it in Indexed Universal Life, and there's case law that says they won't be able to touch that if you have a good attorney defending you on what I just described. So those are some of the main advantages that I would recommend when we talk about using IUL, Indexed Universal Life, to protect your money. Now, I could go on and on and on, but it's an incredible dream solution for many goals, including legal advantages. If this is resonating with you and you want to learn more, I would recommend you study my book, The Laser Fund, which is actually 2 books in one. This white covered side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories, okay? And so right brain, left brain, if you want to use your whole brain, you can read both of these books. Now, it retails on Amazon for between $20 and $60. If you buy it on Amazon, thank you. But I'll gift you a copy free. Simply click on the link below or go to laserfund, L-A-S-E-R, fund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or you like to watch and learn, there's those formats for your investment. You can also schedule to attend a free educational webinar that we teach on a weekly basis. They're free. You can even schedule an appointment to talk to an IUL specialist that I oversee that can answer your questions and create hypothetical illustrations with no cost or obligation, because I would recommend that you make sure it's done correctly. I would say that over 99% of IUL agents in America do not know how to structure one correctly to do what I talk about on this channel. So this is not about me or us, it's about you and protecting yourself.